Well, good morning and welcome. I'm Steve, and thanks for joining me on today's webinar. This is entitled Overcoming Common Payroll Challenges. This session will be about 45 minutes to an hour, but before we start, if you have any questions, please would you use the Q&A function and we'll run through them at the end. If you'd prefer to speak to one of our team directly, our contact details will be shown at the end, or you can visit our website at www.stca.co.uk, where you can find lots of useful information as well as the contact details. Now I'm just going to turn my camera off so that you can focus on the slides. Okay, managing the payroll function of a business can be a time-consuming and at times frustrating task for owners and management teams. The rules surrounding the payroll function are ever-changing, and with the addition of workplace pension requirements and more recently the furlough scheme, the task of ensuring a business remains compliant can be very onerous. During this presentation, we'll go over some of the common payroll challenges and how businesses can benefit from outsourcing their payroll function to dedicated payroll specialists, such as our team at Seymour Taylor. Today, we'll look at upcoming changes to the national minimum and living wage, the complexities of furlough, the upcoming IR35 regulations, calculating redundancy pay, automatic enrollment and re-enrollment, and the benefits of outsourcing your payroll functions. At Seymour Taylor, we support a wide range of businesses with their payroll function, offering advice, conducting payroll processes, and generally supporting firms with any queries they may have. By working with us, you can ensure that you continue to remain compliant with all the latest payroll and employment rules so that you avoid falling foul of employees or regulators. The national minimum wage is the minimum pay per hour almost all workers are entitled to, while the national living wage is higher than the national minimum wage, and workers get it if they're over 25 currently. But this is dropping to age 23 and over from April this year. The amount each worker is entitled to depends on their age and if they're an apprentice. Regardless of the size of the organisation that employs a worker, all are required to pay the correct minimum wage. Minimum wage rates are reviewed every year and typically change at the start of a new tax year in April. This year's increases are as follows. National living wage for 25 and over currently is £8.72. But this goes up to £8.91 and applies to people 23 and over from April. The 21 to 24 year rate is up from £8.20 to £8.36. 18 to 20 year rate, £6.45 up to £6.56. 16 to 17 year rate, £4.55 to £4.62. And the apprentice rate is up from £4.15 to £4.30. You're entitled to the apprentice rate if you're an apprentice aged under 19 or 19 and over and in the first year of your current apprenticeship agreement. If you're 19 and over and have completed the first year of your apprenticeship, you're entitled to the minimum wage age for your range. When calculating pay, employers need to take into consideration any changes in a person's circumstances, such as a birthday and/or any costs deducted from a wage, such as where a person is required to supply their own uniform or equipment. Commission counts towards minimum wage, and total pay including commission must meet the minimum wage each time a person is paid. This means that employers must top up pay if a person does not make enough commission to earn the minimum wage. Some parts of a person's pay do not count towards the minimum wage. These include tips and gratuities, premium pay or overtime, or a loan or advance from the employer. You may be required to make some deductions that could leave a person with less than the national minimum wage or national living wage as take-home pay. This includes tax and national insurance contributions, paying back an advance or overpayment, pension contributions, trade union fees, or a charge for accommodation provided by the employer. You can see accommodation rate information on gov.uk. Employers who pay workers less than the minimum wage are required to pay arrears of wages to the worker at the current minimum wage rates. HMRC can also issue fines of up to 200% of the arrears, capped at £10,000 per worker. In recent years, HMRC has also decided to publicly name and shame the worst offenders, which could result in significant reputational damage. And now we can move on to furlough. The Coronavirus Job Retention Scheme is a temporary scheme open to all UK employers, currently extended until April 2021, that is designed to support employers whose operations have been severely affected by the pandemic. It's already proven to be a lifeline to many businesses and has supported around 10 million workers in the UK during the last year. Employers can currently use HMRC's dedicated portal to claim for 80% of furloughed employees' usual monthly wage costs, up to £2,500 per month for any hours not worked. However, they must pay for the associated employer's NIC, national insurance contributions, and minimum automatic enrolment employer pension contributions on that wage, as well as any wages for hours that are worked. Any UK organisation with employees can apply for the scheme, including businesses, charities, and recruitment agencies. Publicly funded organisations are not expected to use the scheme, but partially publicly funded organisations may be eligible where their private revenues have been disrupted. Employers across the UK can claim whether their business is open or closed. The scheme is open to all employees. Neither the employer nor the employee needs to have used the CJRS previously to use the extended scheme. The scheme will operate otherwise, as it has done previously, and will be open to employees on any type of contract. You will also be able to top up employee wages above the value of the CJRS grant if you wish to do so. Employees can work for any amount of time and any work pattern and claim the grant for the furloughed hours with reference to hours the employee would usually have worked in that period. There is no maximum number of employees you can claim for. This means furloughed employees will be able to work reduced hours paid by their employer in full, while the employer can claim a CJRS grant in respect of 80% of the pay for the usual hours not worked. Although flexible furlough agreements can last any amount of time, unless otherwise specified, the period claimed for must be a minimum claim period of 7 consecutive calendar days. You will need to agree full furlough or flexible furlough arrangements with employees in accordance with employment law and their contracts of employment. The extended CJRS operates as the previous scheme did in several respects. Firstly, employers must report and claim for a minimum period of 7 consecutive calendar days. Secondly, employers will need to report actual hours worked and the usual hours an employee would be expected to work in a claim period. Finally, for hours worked, the employees will be paid by their employer, subject to their employment contract, and employers will be responsible for paying the tax and NICs due on those amounts. Under the rules, the claim period must also start and end within the same calendar month. Where the pay period includes days in more than 1 month, separate claims will be, separate claims will need to be submitted covering the days that fall into each month. These claims should be calculated separately based on the specific rules and contributions for that period. A claim can be made in anticipation of an imminent payroll run, or at the point an employer runs the payroll, or after they've run their payroll. Claims relating to each month should be submitted by day 14 of the following month, unless this falls on a weekend, and then it's the next working day. To apply, you will need a government gateway user ID and password, which will have been given to you when you registered for PAYE online. If you don't finish a claim in one session, you can save a draft, but this must be completed within 7 days of starting it. Businesses looking to make a claim for the first time can do so via HMRC's portal and will need to be registered for PAYE online, to have a UK, Channel Island or Isle of Man business bank account which can accept BACS payments. The billing address on their bank account, this being the address on the bank statements, their PAYE scheme reference number, the number of employees being furloughed, each employee's national insurance number, each employee's payroll or employee number, although this is optional, the start date and end date of the claim, the full amounts that are being claimed, and a contact name, telephone number, and email address. They also need to provide either their corporation tax unique taxpayers reference or their self-assessment unique taxpayer reference or the company registration number. If claiming for employees that are flexibly furloughed, they also need the number of usual hours the employee would usually work in the claim period, the number of hours the employee has worked or will work in the claim period, and to keep a record of the number of hours the employee has been furloughed for in that claim period. Employers are responsible for calculating the correct amounts to claim from the scheme, with HMRC expected to take a hard line on errors that are not corrected quickly. HMRC's guidance walks employers through the various calculations to work out the amounts they need to claim in respect of furloughed employees. The amount you should use when claiming 80% of your employee's wages for hours not worked is made up of the regular payments you're obliged to make, including the regular wages you pay to employees, non-discretionary payments for hours worked, including overtime, non-discretionary fees, non-discretionary commission payments, and piece rate payments. You cannot include the following when calculating wages. Payments made at the discretion of the employer or a client, where the employer or client was under no contractual obligation to pay, including any tips, including those distributed through trunks, discretionary bonuses, discretionary commission payments, non-cash payments, and non-monetary benefits like benefits in kind, such as a company car, and benefits received under a salary sacrifice scheme, including pension contributions that would reduce an employee's taxable pay. To help employers deal with the potentially wide range of permutations, HMRC has published example calculations in the guidance dealing with different situations, which can be found at the gov.uk website. The entirety of the grant received to cover an employee's furlough pay must be paid as money and should not be netted off to pay for the provision of benefits or a salary sacrifice scheme. Where the employer provides benefits to furloughed employees, these benefits should be in addition to the wages that must be paid under the terms of the CJRS. Employees cannot switch freely out of most salary sacrifice schemes unless there is a life event. However, HMRC has confirmed that coronavirus counts as a life event that could warrant changes to salary sacrifice arrangements if the relevant employment contract is updated accordingly. If you receive an overpayment and you're making further claims, it's possible to offset the overpayment against the amount of your next claim. Your new claim would be reduced and you'll need to keep a record of that adjustment for 6 years. If you do not intend to make another claim, you must obtain a payment reference number and pay HMRC back within 30 days. You will only be allowed to increase the amount of your claim if you amend the claim within 28 calendar days after the month the claim relates to, unless this falls on a weekend and then it's the next working day. Employees that were employed and on the payroll on 23rd of September 2020, who were made redundant or stopped working for their employer afterwards, can be re-employed and claimed for. They must have been included on a PAYE RTI submission to HMRC from 20th of March 2020 to 23rd September, notifying a payment of earnings for those employees. Similarly, an employee who was on a fixed-term contract on payroll on 23rd September, and that contract expired after 23rd September, can be re-employed and claimed for, provided the other criteria are met. Employees returning from statutory maternity and paternity leave in the next few months will remain eligible for furlough through the Coronavirus Job Retention Scheme, as long as they meet the existing criteria. However, employees who wish to return early from maternity leave to be furloughed with the agreement of their employer must give 8 weeks' notice. Directors of a company can be furloughed. During this period, directors should be careful to avoid anything that could be mistaken for work, including posting promotional material on their social media feeds on days when they are furloughed. Where furloughed directors need to carry out particular duties to fulfill the statutory obligations they owe to their company, they may do so, provided they do no more than would be judged reasonably necessary. This also applies to salaried individuals who are directors of their own personal service company. Employees can be furloughed where they are unable to work because they're shielding in line with public health guidance, or need to stay at home with someone who's shielding, or have caring responsibilities resulting from coronavirus, including employees that need to look after children. The CJRS is not intended for short-term sickness absences. If, however, you want to furlough employees for business reasons and they're currently off sick, you are eligible to do so as with other employees. Furloughed employees who become ill due to coronavirus or any other cause must be paid at least the statutory sick pay rate. It's up to employers to decide whether to move these employees onto SSP or keep them on furlough at their furloughed rate. In the majority of cases, it will be in the employee's interest to accept an offer of furlough, as it means that their role could otherwise be made redundant. Employers have a variety of options open to them, including reducing employees' working hours, reducing their pay, short-time working, and layoffs, and in some cases, redundancy. Remember that existing employment rules continue to apply, so you must consider whether your actions could lead to a claim for unfair dismissal or discrimination. Grants from the various government schemes to provide support during the coronavirus outbreak are taxable in the same way as other income. You must also deduct and pay to the HMRC income tax and employees' national insurance contributions on the full amount you pay the employees, including any scheme grant. And now we're on to the upcoming IR35 regulations, also known as off-payroll working. Businesses now have just a few months left to prepare for the changes to the off-payroll working rules, also known as IR35. From 6th of April 2021, in most cases, the engager or employer will be responsible for deciding whether to deduct tax and national insurance contributions from freelancers and contractors operating via a personal service company as if they were employees. The new rules do not affect small businesses as defined by the Companies Act 2006, where they meet 2 or more of these criteria. Annual turnover is no more than 10.2 million. The total of fixed and current assets before deducting current liabilities, long-term liabilities, and deferred tax provisions are no more than 5.1 million, and no more than 50 employees. When a business grows from a small to a medium or large-sized business, there is a 2-year transition period before the IR35 regulations would fully apply to that business. It's estimated that almost a quarter of the UK's workforce now works on a contingent basis, either in the public or private sector, and so businesses must be prepared for the changes ahead. Engagers are required to undertake this IR35 determination for every contract they agree with a worker. The official guidelines are as follows. Pass your determination and the reasons for that determination to the worker and the person or organization you contract with. Make sure you keep detailed records of your employment status determinations, including the reasons for the determination and the fees paid. Have processes in place to deal with any disagreements that arise from your determination. The government has created the useful assessment tool called Check Employee Status for Tax, which can be found on gov.uk. This can be used to assess whether a worker is a contractor or deemed employee, and a report can be printed out as a result of your assessment if challenged by HMRC. If the determination results in a contractor being within the IR35 rules, you will need to deduct and pay tax and national insurance contributions to HMRC via the PAYE scheme. Where an employer fails to correctly identify a disguised employment scheme, the worker's tax and national insurance contributions become their responsibility. Where a contractor is hired via an agency, it's the responsibility of the closest intermediary to the personal service company to calculate, deduct and pay tax via PAYE on the contractor's remuneration. Here are some basic steps that all businesses can take to help them prepare. Conduct an audit of freelancers and contractors. As it will be the responsibility of the person engaging the services of a contractor to determine whether their work falls inside the new rules, you should carry out an audit of all employees and contractors currently working within your business to determine who may be affected. Determine who falls under the rules. Last year, many businesses were considering a blanket approach to freelancers, but recent research suggests that more companies are taking a measured approach to ensure they aren't disadvantaging their contractors. You need to determine whether each contractor falls inside or outside of the new rules. This should be done on a case-by-case basis, as you could face serious repercussions for failing to demonstrate reasonable care to correctly classify such roles for employment tax purposes. If the engager fails to correctly determine status, they will be held liable for any tax or NSC charges and could face a penalty from HMRC. Communicate all changes. Once you've determined whether a person falls within the rules or not, you should communicate any changes to them. It is important to demonstrate that you are taking reasonable care to assess their status. If you determine that a person should be within the new rules and you switch them to the PAYE system as required, they could see their take-home pay reduced considerably. You should take the time to discuss these changes with them. A disagreement procedure has been created by the government to be used by the contractor and the organisation paying their fees in the event that all parties do not agree with the determination. Create an agreement policy. Businesses should prepare an agreement policy for any new contractors they take on from April 2021, which clearly outlines the contractor's employment status. Existing contractors might also need their agreements adjusted in light of the IR35 changes if they run into the new financial year. Consider the costs. Many contractors have indicated that they intend to increase their daily or hourly rate to compensate for the tax or national insurance being deducted by employers. You should discuss this with contractors as soon as possible so that you can factor any additional cost into your employment budget. If you rely on the services of contractors or freelancers, it's important to prepare your payroll systems and processes for these changes. If you'd like support with this transition to IR35 next year, please contact us. And now redundancy. Redundancy is unfortunately becoming a growing consideration for many businesses during this difficult period. Once you've conducted the necessary consultations and agreed a redundancy pool, you will need to calculate redundancy pay for those affected. You must pay redundancy to any employees who have an employment contract and have worked for 2 full years. However, the following types of work do not qualify for redundancy pay: armed forces, crown servants, domestic service where they're a member of the employer's immediate family, police, apprentices who are not employees at the end of their training. You must pay at least the statutory amount to your employees, but how much redundancy pay each employee gets depends on their age, excuse me, how long they've worked for you, capped at 20 years, and their weekly earnings before tax, or gross weekly pay. Working backwards from the day of their redundancy notice, you must pay 1.5 weeks pay for each full year they were 41 or over, plus 1 week's pay for each full year they were 22 or older but under 41, plus half a week's pay for each full year they were under 22. The maximum for a week's pay is currently set at £538. The maximum total amount of statutory redundancy pay is £16,140. However, you should check your employment contracts as you might need to pay more than the statutory amount. You can also choose to pay higher amounts if you want to encourage voluntary redundancies. Where an employee's pay changes from week to week, you should calculate the average weekly pay from the previous 12 weeks from the date you made them redundant. If they didn't work for a whole week during that period, for example, they were on holiday or off sick, replace it with an earlier week, and you must share in writing with employees how you've calculated their redundancy payment. Your employees' weekly pay should also include regular overtime if the employee's contract says they must get paid for it, and any bonuses or commission. Any furloughed worker that loses their job is eligible for redundancy based on their normal wage rather than the reduced rate paid under the Coronavirus Job Retention Scheme. New legislation will ensure that workers get the full rate of redundancy pay after it emerged that a small number of employers had taken advantage of the coronavirus crisis to pay employees the same rate as they were being paid under the CJRS for redundancies. The new rules on redundancy also apply to statutory notice pay, which covers the period before a worker's employment ends. This paid notice period typically varies from 1 to 12 weeks depending on an employee's length of service. Under the new legislation, notice pay must be based on an employee's normal wages rather than the lower wages that may have been paid under the CJRS. Note that since 1st December, employees cannot claim furlough grants for employees serving statutory or contractual notice, whether that's for redundancy, resignation, or retirement. The legislation also ensures that basic awards for unfair dismissal cases are based on full pay rather than the reduced wages under the scheme as well. To find out how we can help with calculating redundancy pay and any liabilities that may arise from it, please speak to our experienced payroll team. Now, automatic enrolment. The government wants to encourage more workers to save for their retirement rather than simply relying on what is becoming an increasingly small state pension. It wants all employees to be automatically enrolled into a workplace pension scheme if they're not already in an equivalent scheme, with employers required to contribute to each individual's pension fund. Anyone aged from 22 to the state pension age, earning more than £10,000 per annum, should by now have been automatically enrolled into their employer's pension scheme. Those who fall below this threshold can still join and receive employers' contributions, but employers are under no obligation to enroll them automatically. Those aged under 22 should automatically join the scheme once they reach that age if they're earning above the threshold. Employees can choose to leave the scheme at any time, and any pension built up will stay in place, although they won't be able to get their contributions back. While an employee can opt out of a workplace pension scheme, Employers still need to initially enroll them and to re-enroll them periodically. This system of workplace auto-enrollment began several years ago, and there's been a number of changes to the amounts that employers are required to contribute. Up until April 2018, employers only had to contribute 1% of the employee's salary into their pension scheme. However, changes to the minimum auto-enrollment pension contributions mean that employers must now contribute at least 3% and ensure that staff receive contributions equal to 8% of their wages. It's up to employers whether they contribute the additional 5% or whether it's provided by the employees themselves. As an employer, you can choose which provider to use. Nest, the National Employment Savings Trust, is just one possible provider of pensions via auto-enrollment. However, it may not necessarily be the best scheme for your business. Re-enrollment and redeclaration must be completed every 3 years. You must re-enroll staff who left your workplace pension scheme or reduced their pensions contributions back into the scheme and complete a redeclaration of compliance with the pensions regulator. This declaration must be completed within 5 calendar months of the 3rd anniversary of your original staging date. Auto-enrollment and re-enrollment are not optional, and as an employer, you have a duty to offer your employees an appropriate scheme. Employees can choose to leave the scheme if they wish, but you are legally obliged to offer one in the first place. You could face substantial fines and even imprisonment if you fail to comply. Now, the benefits of outsourcing your payroll. Business owners face many challenges when it comes to their payroll function, and ensuring that a business remains compliant and pays staff the correct wage can be a time-consuming and stressful process. While many management teams attempt to go it alone, there are a number of benefits that come from outsourcing payroll functions to an experienced accountancy firm. At Seymour Taylor, we already work with a wide range of businesses from various sectors to deliver effective outsourced payroll services. Many firms have spoken about the added value that these services provide to them and the peace of mind they get from having our team supporting them. Here's some of the reasons why our clients have chosen to outsource their payrolls with us. Lower employment costs. Hiring a person to conduct a single task, such as acting as a payroll manager, can be very costly, especially as these skill positions often demand a higher wage. By using outsourcing, a firm can reduce its need to recruit and lower employment costs, including costs related to pensions and holiday pay. Continuity of service. Many companies may only employ a single person to fulfill their payroll function. When that person is unavailable due to sickness, holiday, or some other reason for absence, then there may not be a person to fill their role. So often this means that the responsibility falls back on the business owner. By outsourcing, you're guaranteed greater continuity of service thanks to the larger team that's available within a firm such as Seymour Taylor. Experience and expertise. By using a team of experts instead of a single person employed by the business, owners are able to call upon a wider range of knowledge and experience, including from more senior team members. The rules surrounding payroll are complex, as we've outlined in this presentation, and so having a team of dedicated payroll specialists, it's easier to remain compliant and have issues resolved swiftly. Connections. By working with a payroll team within a firm of accountants and tax advisors, businesses can gain access to experts in other fields who have close connections or the expertise to deal with difficult or obscure matters. This may include quicker access to trusted advisors in areas such as employment law or recruitment. Reduced overheads. By having fewer employees, businesses require less office space and equipment, which can help to keep overheads such as bills and rental costs down. Fewer development costs. Those handling vital financial procedures within a business are often required to undergo continued professional development. Keeping up to date with CPD requirements and the latest regulations often requires staff to attend expensive courses. With outsourcing, this cost is incurred by the outsourcing partner firm, which is required to maintain these standards anyway, and will often go beyond this to invest in new areas that support clients. System improvements. By working with an accountancy firm, you're likely to find that they have ways of improving your payroll systems using the latest technology, including cloud accounting. This means that you may have better access to the information you need to run your business. They may also be able to streamline processes to reduce the time spent on maintaining payroll records. Confidentiality. Payroll can be a sensitive area for many businesses, and by outsourcing this function, it can be kept one step away from the normal business processes. Help with HMRC. The costs of defending a challenge from HMRC can be considerable, and every business is likely to receive an inquiry at some point, even where it has acted within the rules. By having a team of outsourced specialists on hand, you should be able to resolve issues quickly and accurately without having to seek out additional advice elsewhere. Save time, reduce stress. One of the main benefits of outsourcing some of your business functions to specialists, such as the team at Seymour Taylor, is to save you time and to reduce the pressure on you as an owner, leaving you free to focus on running your business. As this presentation has hopefully demonstrated, managing a compliant payroll can be a very onerous and time-consuming task for business owners and their management teams. While many firms choose to go it alone, there are clear benefits from having experts on hand to provide advice and support with payroll issues. This last year has seen considerable change to the way employees are paid, which has required businesses to adapt quickly. Further changes are expected in the years to come, especially as a result of Brexit and the ongoing COVID-19 pandemic. To ensure you have the support you need to remain compliant and to reduce the stress of managing a payroll, why not let us help you? Give us a call or drop us an email to find out more about our payroll services. Well, that's it from me. I'd just like to ask my colleague Suzanne if there's any questions that need to be answered.
Thanks, Steve. We did have a couple of questions that came in before. The first one was, what if I forgot to do a furlough claim and have missed the deadline for that month?
Oh, right. Okay. Well, that depends on the reason why it was missed. If you call HMRC's helpline to explain what the reason was, they will be able to tell you if your reason's valid and tell you what will happen next. I think simply forgetting is unlikely to get you anywhere. But if there's a specific reason for it, such as a illness or something like that, then there's a very good chance they'll let you put the claim in.
Okay, thank you. And the other question was, does IR35 apply to workers overseas?
Well, that depends. If the overseas personal service company is providing services in the UK, then you would need to consider the status. So probably yes, then.
Okay, I can't see any other questions in the Q&A. Just have a look. No, there's no other questions in the Q&A.
Okay. Right. Well, that's it then. Well, thanks everybody for watching. Feel free to get in touch or check out our website. Goodbye and stay safe.